Hi there, you're watching Market Cafe on ET Now with me, Shreyanshi Singh and Kanishka Sarkar. And over the next 1 hour, we'll get you updates from within the country as well as across the globe. Also tell you which stocks you should be keeping on your radar bright and early this morning. And well, speaking of stocks then, Kanishka, first things first, let's take a look at the handover coming in from Wall Street.
Good morning, Shreyanshi. Absolutely. Well, first let's take a look at Wall Street, how the Wall Street fared yesterday. The US stocks ended slightly lower overnight as tariff uncertainty stayed high. Shares of consumer and healthcare companies eased while upbeat results from banks provided some support. Now, all three major averages fell following back-to-back winning sessions. The Dow Jones Industrial Average lost about 150 points. The S&P 500 declined 0.17%, whereas the Nasdaq Composite ticked down 0.05%. Now, shares of Bank of America and Citigroup rose following their results, as I mentioned earlier. Now, still, bank executives have warned that US consumer spending faces huge risks if the upheaval sparked by President Donald Trump's trade policy goes on. Among the biggest weights on the Dow was Boeing yesterday. Now, the stock has fallen 2.5% nearly after reports that China has ordered its airlines not to take further deliveries of Boeing jets in response to the US decision to impose 145% tariffs on Chinese goods. Now, moving on, AI giant Nvidia has also said that it would take $5.5 billion in charges after the US government said it would require licenses for exports to China of its H20 artificial intelligence chip, which has been one of the most popular chips. Now, Nvidia's shares were down about 6% in after-hours trading, that is after this news. Meanwhile, Trump's April 2nd announcement of sweeping tariffs sparked turmoil in the market and fueled worries about a global trade war and possible recession, as has been the case through the weeks. Now, trading has been more subdued this week, but investors have been unable to focus on much else. Now, remember, S&P 500 companies have just begun to report their results for the quarter ended March 31st, but changes in US trade policy are muddying the outlook and executives could be reluctant to give earnings guidance. The S&P 500 remains down over 12% from its February 19 record high close and down about 8% for the year to date.
Well, absolutely. So that's the handover coming in as far as Wall Street is concerned. But with that in mind, let's also take a very quick look at oil as well as gold. First things first, let's take a look at oil prices because they inched down after you did have the International Energy Agency following OPEC in slashing its oil demand forecast. Though you did have prices that would fall, the fall, in fact, that was limited by US President Donald Trump's suggestion of some new tariff exemptions. So when you take a look at price levels, then Brent crude futures, a downtick of just about 21 cents or 0.3% thereabout. $64 per barrel is the level that you're looking at for Brent. And when you take a look at US WTI as well, you're looking at a 20-cent downtick there as well, 0.3% downtick. Even for WTI, $61 per barrel is the level that you're looking at for WTI. Now, the IE, of course, also cut its forecast, like I mentioned, for global oil demand growth to 730,000 barrels per day this year. That is down from 1.03 million barrels per day. And to also 690,000 barrels per day for the next year, citing escalating trade tensions. So that is something that you're looking at in terms of the forecast. But other than that, of course, you do have demand fears and potential oversupply also. That is something that we're looking at. That is slightly weighing on prices even as we speak. When you take a look at gold, on the other hand, gold was holding near those $3,200 per ounce levels on tariff jitters at this point. Of course, you do have safe haven demand playing in. But at this point, that's not much of a factor because it has largely been priced in. But let's really see how that works out with US President Donald Trump's commentary coming in further through this week.
All right, then moving on, lots of global cues to watch out for today. In the US, retail sales data, industrial production data is going to be out today. In terms of China, China is going to report its GDP data, retail sales data, as well as industrial production data. Both UK and the Eurozone will see their CPI data coming out today. In terms of global earnings, Alcoa is expected to report its results. Now, in terms of corporate action back home, Mazgon Docs is to trade ex-dividend today. IT giant Wipro will be reporting its quarterly results. In terms of other events, the Supreme Court is going to hear pleas challenging the Waqf Act. Across the globe, Fed Chair Jerome Powell is expected to speak later in the day. Also, Dallas Fed President Lori Logan is going to speak later in the day.
Pretty lots to look at when it comes to those speeches as well. But moving on, let's get you the top headlines this hour. Then the US has declared the ball is in China's court as US-China tariff tensions hit new highs. In fact, at a White House briefing, Press Secretary Karen Leavitt also said that Trump is open to a deal, but only if China steps up. In fact, she quoted the president saying, "They need our money," underscoring that global players want access to the American consumer. Certain tech products, the likes of smartphones and laptops, have been spared for now. But remember, Boeing shares took a massive hit after China ordered a halt when it comes to new orders.
Lots of news coming in as far as Trump's actions are concerned. Now, Trump has signed a healthcare executive order with a notable big win for Big Pharma. Now, he's pushing to delay Medicare's price negotiations for pill-based drugs by 4 years, aligning them with complex biotech meds. Now, the move echoes industry lobbying and requires Congress to act. Now, while aimed at cutting healthcare costs, critics say that it could blunt the Biden-era Medicare reform that first gave the program power to negotiate drug prices for millions of seniors.
Amid the ongoing trade war, Trump has in fact ordered a national security probe into all US critical mineral imports. In fact, he invoked the same trade law he used to slap duties when it comes to steel and aluminium, aiming to curb the country's deep reliance on China for vital materials the likes of cobalt, nickel, and rare earths. Now, the order in fact warns that foreign control over these supply chains threatens national security as well as economic stability. And remember that China has already retaliated with rare earth export curbs.
Absolutely. Another update coming in from US. Now, US Treasury Secretary Scott Bessent is downplaying fears that China could weaponize its more than $750 billion treasury holdings despite the ongoing bond market volatility. Now, in an interview, he said that there's no risk of China dumping US debt, noting that it will hurt their own economy by strengthening the yuan.
Moving on, Nvidia is bracing for a $5.5 billion hit this quarter linked to its H2 AI chip exports to China as well as other regions. Now, the H2 was built to dodge US export curbs, in fact, but fresh restrictions now demand a license. The stock, in fact, dropped over 6%, like we mentioned earlier, in after-hours trade, raising concerns that Washington's crackdown could finally catch up with AI tech darling Nvidia's breakneck growth.
All right, then moving on, let's get you an update from the aviation space. Now, United Airlines is hedging its bets for 2025, offering two profit forecasts as it calls the economy impossible to predict. Now, it sees earnings anywhere from $7 to $13.50 a share, depending on whether a recession hits or not. Now, while international and premium bookings are flying high, domestic travel demand is sputtering. Still, United Airlines says that it'll stay profitable irrespective of the turbulence.
Moving on, OpenAI may be plotting a bold move into social media, taking on Elon Musk's X and Meta's Instagram. In fact, according to reports, the idea is still early, but it is fueled by the viral success of OpenAI's latest image generation tool, which has been crashing servers. However, if it pans out, we could be looking at the next AI-powered social playground.
All right, then some positive news coming from back home. Now, India's persistent inflation is finally showing definite signs of easing. Retail inflation for March has come at 3.34%, which is not only lower than the 3.6% we saw in February, but also lower than the 3.5% which economists were penciling in for this month. Now, in fact, now retail inflation is at the lowest levels since we last saw in September of 2019. Now, talking about the specifics, food inflation fell to 2.69%. However, core inflation, which excludes food and energy prices, saw a mild uptick coming in at 4.1% versus 4% in Feb. Let's listen in to the experts we spoke to about the inflation trend.
See, the main problem with the food prices or food inflation was with the vegetable prices, right? And with vegetable prices now coming under control, I think for the at least for the foreseeable future, for the next 6 to 7 months, we do not see much of a pickup that we should be seeing in the food prices. All the other elements, whether it is spices, edible oil, etc., cereals, have been much more well behaved. And as such, the durable portion of the food inflation has been coming off. The volatile part of the food inflation, which one can put about, which one can classify as, let's say, vegetable, fruit, etc., that has been also coming off. And now we finally see the print on the food inflation coming at around 2.6%, kind of is now, I would say, the comfort zone on the food inflation is visible.
Overall GDP growth numbers, I think we have a forecast of 6.4 to 6.6, which is roughly close to what RBI is saying. We are keeping a range of 6.4, worst case scenario 6.6 otherwise, in case things turn out to be good. But at the industry level, there's definitely going to be disruption. So I think that's where the government has to do some kind of intervention to ensure that we're able to protect these industries, maybe through a finance route, maybe giving other kind of incentives, PLI-like schemes for them, to ensure that we're able to be on our toes at a time when competition increases, both in terms of cheaper imports coming into the country with the reduction of tariffs, as well as competition which Indian commodities would face in global markets on account of the higher tariffs which are there.
Our own forecast at CRISIL is that growth is, our current forecast is 6.5, but it definitely has a downward bias. Now we are looking at two things: the direct impact that comes in because of UF tariffs, because we all know that there will be some, but the bigger indirect impact essentially comes in from the fact that global demand and global growth is expected to be weaker. So India's trade partners seeing weaker growth will also manifest into India's GDP growth. Now, having said that, I don't think that we have it's not like a big global shock that will materially bring down India's growth forecast, because a lot still depends on domestic drivers. And I think the domestic drivers, one coming in from government's capex spending, the other coming in from consumption holding up because we have lower interest rates, lower inflation, we have the tax rate cuts, etc. I think those will play a large role in terms of supporting growth.
Amid the ongoing global tariff war, India's trade deficit surged to $21.54 billion in March, while exports, on the other hand, grew marginally by 0.7% to $41.97 billion. Imports also increased by 11.3% on a year-on-year basis, so $63.51 billion is the number that you're looking at when it comes to imports in March as well. In fact, Sumit Chaturvedi is standing by with more details. Sumit, take us through the fine print when it comes to these numbers.
At the time global tariff wars are going on, India's trade deficit has widened to $24.5 billion in March and against the expectation of around $16 billion. So the trade deficit is the difference between exports and imports. It clearly shows that imports are more than exports during this period. If we talk about the overall merchandise exports, in FY25 they stood at $437.42 billion as against $437.07 billion in FY24. Countries' overall export of goods and services, they've increased by 5.5% to $820.93 billion. Clearly, we all are aware of the overall tariff war that are going on. 90-day pause has been given, but there is still uncertainty what is going to happen. As far as India and US are concerned, both our countries are engaged in bilateral trade talks, bilateral trade agreement, and the talks are going on. Currently, India is trying to seal the first tranche as soon as possible, for which several rounds of talks have already taken place. So there are many concerns and many opportunities when it comes to trades with US as well. But as far as trade deficit is concerned, it is widened in March as the figures according to which we told you.
Well, that's the fine print as far as India's trade deficit is concerned. Now, moving on, we also caught up with Garima Kapoor of Elara Capital and Jayant Dasgupta, who's the former ambassador of India to WTO, to get us an expert view on India's trade deficit expansion in March. Listen in.
I think two things to understand in the March deficit print. Number one, it is much lower than what you saw in December and January. So it is not an aberration. Number two is this reflects a lot of purchases that happened, particularly excess imports in anticipation of implementation of tariff. If you look at China's number and China's exports to India, they grew by 13% in this month of March, highest since 2018 third quarter, if you exclude the COVID-related disruption. So what that tells you is that there has been a lot of advance purchases or advance importing before the tariff regime got implemented officially. So while these numbers look little discouraging at the headline front, especially the deficit as well as the import number, there is a reason behind this. I don't anticipate this to continue in the coming quarter.
I think we are putting a greater emphasis on negotiations and the negotiators' skills rather than on domestic reforms. You are only good at the negotiating table as your own economy. So once you start producing things competitively, whether it is a good or a service, you will be able to sell it and you will be able to get market access because you will also be able to offer something in return. When you have your own act not quite up to the mark, then no matter how skillful a negotiator you are, you will always be fighting a defensive battle. So the first thing is that you need to have domestic reforms across a wide swath of areas, starting with land, labor, the essential elements, and all kinds of clearances.
That's a closer look at India's trade deficit and what the numbers then indicate. But it's time for a very quick breather on the show. When we come back, we'll take a look at how the Asian markets are faring. Don't go anywhere. Welcome back. Thank you so much for staying tuned in. Well, it's time now to get you an exclusive with the JSW Steel boss Sajjan Jindal. And he was speaking to my colleague ET Now's Anurag Joshi about tariff troubles as well as tough love for the Indian steel sector as the global trade war heats up. Can India stay battle ready? In fact, he also spoke about gearing up for the fast lane with the IPO buzz around the JSW MG Motor India JV as well. Let's go across and listen in.
Industry needs protection because there is a lot of dumping that's happening and imports have really grown in India, import of steel. So therefore, whatever Commerce Ministry has recommended, though Steel Ministry wants more, but at least we should start with that.
So MG Motor right now in listing the company, the joint venture, what is the timeline for that?
For
MG Motor?
Right now, MG Motor is not of that scale where it can be listed. So once it starts to sell that many cars, then only it get listed. So maybe 2-3 years down the road.
You had a target of 65% of EVs from the joint venture with SAIC. So how long will that take? Where have you reached? Can you give us some idea on that, sir?
The 65% of MG's production is EV. Even today it is 65%. But the EV market as a whole is pretty small. It's only about 2.5% of the Indian market. So that has to grow bigger.
So JSW Paints, that's one of the front runners for the AkzoNobel assets in India, the decorative paints business. How soon are you looking to close the deal? I mean, where's the deal right now?
So we are in the process, and it wouldn't be right for me to comment as of now.
As the tariff war continues and countries are fighting against the high reciprocal tariffs, we spoke with Kamal Bali, who's the president and MD at Volvo Group India. He highlighted the concerns of high tariffs and how it will affect the consumers. Let's listen in.
Absolutely, I think across the world there is a concern today of high tariffs, and because there can be a vicious cycle of many countries coming up with tariffs, so which is not good for the consumer, which is not good for economy, which is not good for demand. So I think, and at the end of the day, it is not good for the society at large, So of course there can be inflationary pressures on one side and lower demand on other side, which means you could end up into a situation where there is stagflation. So which is not a good scenario at all to my mind. But I'm sure, I think good sense will ultimately prevail on this entire political ecosystem.
Then moving on, global markets were rattled by a wave of trade tensions triggered by US tariffs. In fact, my colleague Sumita spoke with Sunil Kant Munjal, who's the chairman of Hero Enterprise. He emphasized on how global trade has been disrupted and the need for reforms even. Let's go across and listen in to a slice of this exclusive conversation.
It's more than just India and the US. It's a global trade which has got disrupted. And I think that needs to settle for people to get back to business as usual. I don't think it will be business as usual as it was. We will have a new reset taking place. And I think if we are smart, we will not only look at this as an external focus things, we will also focus inwards and do massive reforms that are left over at this moment.
Very well put, sir. But when you talk about this disruption, we are also hearing from the Trump administration that with respect to the auto and auto components sector, there might be some relief on the anvil because he wants these companies to make in America. So if he's asking companies to make in America, how does that impact the other manufacturing powerhouses like China, for instance, or India for that matter? How can India make the most of these developments?
I'm less concerned about India auto component industry because auto components from India are very, very efficient. We are today one of the more efficient in the world. We are providing components now to component systems and subsystems to most automotive companies in the world, including to some in China, by the way. There will, of course, be some disruption for India as well. There will be some pain, but I think in the long term, there is great gain.
All right, now let's give you an update on IndusInd Bank. PwC, the Big Four firm engaged by IndusInd Bank to quantify the impact of accounting gaps in past derivative trades, has estimated potential losses from those anomalies at almost 2,000 crore rupees. As per the lender, which said that in a disclosure. Now, initial estimates had pegged expected loss at around 1,600 crore rupees. Although, as a percentage of net worth, the PwC assessment is marginally lower. My colleague Ankur Mishra joins in with all the details.
Yes, IndusInd Bank has now disclosed that external auditor, which is said to be PwC, has quantified the discrepancy in the derivative portfolio at rupees 1,979 crore. Now, this figure is important because earlier on 10th of March, bank had already disclosed that there is a discrepancy in the derivatives portfolio, and they are pegging it over 2.3% of net worth. But if you take the current number into account, it comes marginally below that estimate. So all in all, the number is coming in line with what was guided by the management earlier. And more importantly, there is one more audit which is continuing, and we understand through sources it is by Grant Thornton, which is still pending, while the current audit which was given the task of quantifying how much is the discrepancy in the portfolio, another audit is going to check the processes, whether or not the processes were followed properly. So that audit is still awaited. The bank will submit all its report to Reserve Bank of India, and it will be on the regulator whether or not any fresh action needs to be taken on IndusInd Bank. But for now, the number is out. The quantification is done by the external auditor on a derivative portfolio, and the negative impact is 1,979 crore.
All right, thanks Ankur for getting us all of those details. But moving on then, according to ET Now sources, the government is working on new measures to check dumping of steel imports post a hike in tariffs by the US administration. In fact, Prakash is standing by with more details. Prakash, take us through what your sources are telling you.
The government is planning to discourage steel dumping in the country, especially after the US government's decision to impose a 25% tariff on steel and aluminum products. That's an important development coming in. The Steel Ministry has held an important meeting with the stakeholders under current circumstances where several tariff and non-tariff measures are expected to be announced. We're given to understand that quality control orders will be expanded to curb cheap imports. In fact, almost all grades of steel will be covered under quality control orders. In fact, the process has been initiated. Currently, almost 2,000 grades of steel products are under quality control orders, and now the Steel Ministry is moving ahead with the fresh proposal. Industry has already approached government. The issue has been discussed widely, and now the government is expected to announce several measures to regulate cheap imports. When it comes to tariff measures, imposition of safeguard duties on steel products from China and Vietnam is already under active discussion of the government, which will be announced very soon, where DGTR has made a recommendation to impose 12% duty on certain category of steel products.
Well, that's the latest as far as steel duty is concerned. Now, moving on, this long weekend brings a little bit of bad news for flyers. Now, flight prices have soared high to an average of 2 to 5 times as compared to normal fare prices. My colleague Anjali Palur joins in with a breakup of major routes and changes in the fare prices. Anjali?
As another long weekend comes up starting 18th of April, which is Good Friday, people are looking to make the most out of the 3-day long vacation, and this is leading to ticket prices soar across different locations in the country. So a Mumbai to Delhi flight on the 18th morning would start at rupees 11,000 versus the average price for this sector, so on any regular day, would be rupees 4,950. So this is around a 2 times increase in flight prices. If you look at Mumbai to Goa, now this sector on an average a flight would cost you rupees 2,596. However, on 18th morning, these flights start at a minimum of rupees 12,500. If you look at the Mumbai to Varanasi sector, the flights on 18th morning are starting at rupees 12,000 versus an average fare of rupees 5,924. That is a 2 times increase. A Mumbai to Dehradun flight would start at rupees 11,700 versus an average of rupees 7,935. So across different sectors, the flight prices are going as high as 5 times the regular average ticket fare, which is a testament to the fervor, the frenzy amongst people to make the most out of the long weekend that is coming up.
Well, absolutely. Thanks, Anjali, for getting us all of those important details. Time to take a quick look at some important data coming in from Beijing as well, from China. China's economy, in fact, expanded by a better than expected 5.4% in the first quarter. So maintaining a strong momentum, that is something that you're seeing as far as the economy then is concerned. When you take a look at the March industrial output as well, that has risen 7.7% on a year-on-year basis from a year. It's expanded, in fact, by 7.7% from a year earlier versus that median estimate that we had of 5.8% coming in there as well. When you take a look at retail sales, 5.9% on a year-on-year basis, the kind of rise that you're seeing for the retail sales for the month of March. And that is something that is sharply beating estimates for a 4.2% growth as well. Even when you take a look at industrial output, like I mentioned, 7.7% is the rise coming in there as well, and fixed asset investment also rising 4.2% in the first quarter against the estimates of 4.1% increase. That was largely being penciled in. So that is something that you're seeing on the back of that. When you take a look at Shanghai, as you can see it on your screens as well, 0.5% decline coming in for Shanghai, which is lesser than what you had earlier as well. Hang Seng as well, 1.7% downtick coming in for Hang Seng. Slight recovery is what you're seeing as far as Hang Seng is also concerned. But that's largely the kind of update that we have coming in as far as China's GDP is concerned. But on that note, time for a very quick breather on the show. More news and updates on the other side.
Welcome back to ET Now. You're watching Market Cafe with me, Kanishka Sarkar, and Shreyansi Singh. Well, as we are headed for a nearly flat start, my colleague Ansh is here with an F&O snapshot.
Well, in the previous session, Nifty was up by more than 2%, registering biggest single session gain at least for this year. Also, if you see on chart, the Nifty has surpassed above that 7th April's gap down range. It has also surpassed above 50 DMA, but that 100 DMA is somewhere where we are facing some hurdle. This 100 DM is around 23,400. Also, it is the lower bound of that previous consolidation range. So we need to go above this 23,400 to be on a strong bullish side. Also, if you talk about index option, then we are seeing some put writing happening at the 23,300 mark, indicating some support base around this level. Nifty is just around this level only. If you talk about Nifty Bank, then here also we saw a very good jump, because in the previous session it gave directly jump above that consolidation pattern, and we are staying above that 52,000 psychological mark, which is a very positive sign. So unless and until we don't give a breakdown below this 52,000 level, we can expect some good positivity in the market in banking space. Also in index future, we are seeing that open interest has gone up by around 3.7%, indicating significant long build-up happening. Now, if we talk about index futures, then in previous session, FI have actually added long by around 4,100 contract. They have covered massive short by around 9,700 contract, due to which the total long position has gone up from 25.4% directly above the 28% to 28.1%. At the same time, if we talk about retail, then they seems to be getting a bit cautious, because they have covered their long position. Maybe they are getting into profit booking here. At the same time, they have covered their short position as well, due to which the total long position is at 57% currently.
Okay, thanks, Sanj, for getting us that update. Let's also talk about Wipro while you're still with us, because that one is also all set to report its Q4 numbers. Muted quarter looks to be in store when it comes to Wipro, but take us through what else is being penciled in.
Well, yes, sir. So the company had guided for a constant currency growth of -1 to +1% for this quarter, and it is expected to be -0.6%, which is well within the guided range only. If we talk about IT service revenue, then that is expected to be at $2,597 million, which is down by 1.2% sequentially. And this is mainly because of weakness in manufacturing and some hurdle in European region. However, if we talk about revenue in rupee term, then that is expected to rise by 1.5% to 22,643 crore. IT service margin is likely to slip 20 basis points from 17.5% to 17.3 basis to absorbed in Q3. If we talk about profit, then that is seen at 3,290 crore, a decline of 2.3%. Now, apart from these numbers, there are 4 key things to watch out for. First is commentary on Q1 FY26 guidance. Second is any insight on BFSI and discretionary spend. Third is trend in headcount and attrition. And fourth is update on consulting business. So the bottom line here is that revenue is expected to be within the guided range, but the main focus would be on management commentary.
All right, then that's the preview as far as Wipro Q4 earnings are concerned. Now, moving on, a 90-day pause on 26% tariffs is a positive move for sure, but the threat of a global tariff war continues to linger. How will Indian markets and the economy brave the storm, and is India better placed as compared to other nations? Top market veterans chime in.
One has to really be very careful and cautious about export-oriented companies or export-oriented sectors. So that's one place to kind of really maybe avoid in this environment. But I still think the demand for pharma is going to be inelastic. I mean, no matter what tariffs are imposed, I don't see why suddenly there's going to be an alternative source for the United States to basically buy its pharmaceutical requirements, irrespective of the tariffs imposed. So I think we will live with some uncertainty. Maybe, in a few weeks, few months now, even these two pockets would probably create very attractive buying opportunities. Metals is something which one would avoid right now, because again, it's a factor of global demand, global prices.
Given this current tariff situation continues, India tariffs lowest being only stands out as an edge for India rather than a risk for India. So Indian producers will be far better placed in terms of exporting to US than anybody else. And if that's the case, then the worry should not be there. It should be seen more as a comfort. If the commodity prices remain soft, it helps India. I think India is not in a very mega inflationary environment. We are in a reasonably well-managed inflation environment over the last many years, including during the Ukraine war time.
Barring China, the rest of the world will conclude reasonably constructive deals with America over the next 90 days. China will try to dump on everybody, including India. And the main way for us to deal with that is, I think we need to consider depreciating our currency. Beijing is already depreciating the RMB aggressively. I think we'll see more of that from Beijing in the coming months. And I think we'll also have to consider flooding the system, our banking system with liquidity, The RBI has begun doing that. It's a step in the right directions. We need more interest rate cuts from the RBI, and I think we need the rupee to move towards 100, 105, given the rate at which Beijing will depreciate RMB.
Or rather than moving on, let's get you some more commentary to start your day right. In fact, amid the relentless tariff tantrum and the global markets turmoil, how is the Indian market then poised to perform? Is the market in fact going to face severe storms ahead? And which sectors should investors then be looking at and which ones to avoid? Let's go across and listen in to what the market honchos then had to say.
For principal protection and those who are really worried about volatility, maybe still fixed income might be a better place. But nevertheless, I would still actually think that equities over the medium to long term has the potential to deliver double-digit kind of returns. That's been the case so far. And I don't see that changing given the fact that India itself, nominal GDP growth will grow at about 10%. So I'd still think that this is a time still to be in equities and maybe use this current bout of correction to keep increasing allocation to equities depending upon one's own risk appetite.
We are in a good growth environment as far as Indian equities are concerned, economy is concerned. And at 17, 18 times price to earning, Indian Nifty does not look at all expensive. It is very, very good proposition. Whenever there's a fearful environment global level, it is rightfully that markets can be edgy. And that's the reason I believe that I don't see deep downside from here unless some, again, catastrophic event happens, globally. I mean, no, it's very hard. My sense is that we are in and around 500 point plus minus from here. We should be in this range, and as the earnings come out, as the issue settles down, we should resume our trajectory. My sense is that in this quarter, April, May, June quarter, all these things should settle down, and June onwards we should look good. I don't think Q1 being a washout kind of quarter for Indian corporate by and large. You can have one or two segment or sub-segment, but broadly, I don't think there's any sort of major washout expected.
Large caps, we're not that worried about valuations, but small and mid cap valuations are still unusually high. We have worked very hard in our small and mid cap portfolios over the last 7 months to sell the expensive stuff, to go into cash, to bring the portfolio valuations down as much as we can. But I think small and mid caps in India have another 30-40% to go before the valuations can be deemed to be attractive. Large caps are all right, especially the kind of quality large caps that we like are all right. At this juncture, at current valuations, it's not clear to me that there is a bull market button to be pressed in India. So unlike March 2020, when we were happy to buy aggressively, we're not buying aggressively at the moment because we can see the domestic weakness.
That's the outlook of market experts as far as the current market scenario is concerned. But before we head into today's trading session, my colleague Gaurav is standing by with all the list of stocks to keep on your radar today. Gaurav.
Let's begin with the earnings candidate. So we will be watching out on the Angel One because this company will come out with the results. But on the other hand, there are some companies which will be in focus on the back of their Q4 earnings. So first, let's talk about ICICI Pru Life. A good set of numbers because net profit increased almost by 120% on a year-on-year basis. On the other hand, when we talk about IRIDA, there also we saw a good set of numbers because when we talk about profitability, we saw an uptick of around 48.7%, while net interest income also increased almost by 57%. On the other hand, when we talk about ICICI Lombard, we saw a little bit of weakness because GDPI growth was only at 10%. And on the other hand, when we talk about combined ratio, that remained at around 102.5%. Other than that, there are some stocks which will be buzzing on the back of the news flow. So first, let's talk about Max India because company is going to consider fund raising of around 125 crore rupees via rights issue. Other than that, Oil India is also going to be in focus because company has now secured 9 blocks under OALP 9 adding. This will add actually 51,000 square feet of the exploration portfolio for the company. And lastly, let's also focus on NHPC because company has now declared commercial operation has been started for one of their facilities in Himachal Pradesh. So definitely watching out on all these counters on the back of the news flow that we have received in the morning.
Absolutely. Thank you, Gaurav, for getting us that update. So there you have it. That's the list of stocks that you should be keeping on your radar bright and early this morning. But with that completely timed out on this show, thank you so much for tuning in. The market takes it ahead, so stay tuned.
If you like this video, then like, share and subscribe to ET Now.